Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So the market is giving us great opportunity to right now look for high quality businesses that are undervalued. Okay, and I think this is going to continue happening for probably another month, if not longer. There's so much uncertainty about wars, about inflation, about the fact that interest rates might still stay where they are. All of these things, and top of that, the earnings reports. Some of the companies have reported earnings that were not great. I know the big mega companies are doing a really great job of that. But yeah, there's so much uncertainty, and we're still not out of the woods, and I don't think we will be at least until summertime. And my plan, as always, is continuously buying high quality companies. And again, I'm just going to do my own research, find out companies that I think are high quality businesses, and then dollar cost average every single month. And the reason I want to do that is because I cannot be relying on Wall Street and what happens this week or what happens next week. I want to focus on the long term. Some of the businesses or some of the companies that I own in this portfolio have been here for very, very long time. So companies like Cummins, for example, has been in this portfolio for quite some time. So now I'm up 38%, 39%. So Home Depot is one of the companies that I purchased very, very early on. They're not high flyers, but it's still doing good, 21% up. At least I'm not down. J&J is another company, has come down quite a bit recently, so I'm starting to look at it again. So I've got a video coming up, inshallah, just to kind of go over. Medtronic is another one. It hasn't been here for long time, but long enough. But then Merck has been here for quite some time. In fact, I'm not even sure if I can show you. Yeah, I bought my first share of this company 17th of December 2020. Since then, I've been buying every single week and getting paid that dividend. So it is important to look for the long-term returns, and one of the things that I want to do, by the way, one of the brothers, I apologize, by the way, I think normally used to, because of this is now in the way, you cannot see the average prices, and one of the brothers have asked me recently and I completely forgot. So there's the average price for this company. So £57 or 77, let's call it $78, and right now, as you can see, is over $130. So one of the reason I'm talking about this is because I was buying when it was actually nobody was looking at this company, and it was trading around this price, and at the time I kept saying it's undervalued, and I kept buying to the point where it's just basically kind of got away from me at some point. So, and then I stopped buying, and I have not actually purchased one single share of this company for quite some time. I don't even know the last time I actually purchased. There we go. That wasn't even a massive buy. Last time I bought, there we go. So 2022, February 2022 is the last time I actually bought, 2 years ago, and any shares of that company. Because I felt like it was a bit overvalued at that point, and I just left it alone. So what I'm trying to do is look in my portfolio, buy high quality companies, hold them for a long term, dollar cost average, and especially when people do not want to touch these companies, that's the time that I'm looking at. Like I keep saying to you guys, I'm going to keep buying this company in the next few weeks. And the reason I want to do this is because now it's actually out of favor. Most people are not looking at this company. So I'm going to continue buying. But the company we're talking about today is not this one. The company we're going to talk about today, I will mention that to you guys in a second. Okay, by the way, if you want to know the average there, that's the average. But the company I'm talking about today is slightly different. But before we do that, if you could like the video, subscribe to the channel, that would be absolutely wonderful. And of course, if you could join us on the Patreon account, where you get access to a lot of things, the buys, the sells, the stock watch lists and all of those things, as well as the Discord, where you can share good practices with a lot of brothers in there. But the companies we're going to talk about today is Hershey's. Hershey's is one of those companies that are, they are consumer staples. They have excellent brands of basic snacks that they sell. They have come down quite a bit for a reason. Okay, this is although consumer staples, they're a little bit more discretionary, but their product is not actually that expensive. Hence why I actually really like the business model, and I like the company. So I've recently started a position, and I've been buying since. I'm down a little bit. I'll show you at the end. So what I want to do is kind of go over some of the reasons why basically I like this company, and at the end I will show you I'll tell you what my plans are. So one of the reasons the stock is basically down quite a bit is this reason. So November of this year, the price of cocoa basically has been around here. There we go, just about $4,000 US. to right now, it's gone up almost to 12,000, and I think it was 12,800. I think at some point, there you go, 12,800. And the reason is that basically this is happening is the International Cocoa Organization have recently said they kind of forecast a shortfall for basically for harvest about 10%. And the reason they're saying is a shortage of farmers, age of trees, some disease that is basically killing those trees, as well as the climate change. So, and as you can see here, the price basically came down a little bit now, but it's been up, and a lot of it is basically driven the worst supply shortage, like I said, now in 40 years in West Africa. Latest data shows that the top producers average cost to basically ship to 1.33 of their cocoa to ports from, that's down about 30%. Okay, and Ecuador is actually now doing okay-ish if you think about it. So look at this price basically from where it was to where it is right now. And for that reason, what does that mean for the company? The companies like Hershey, for example, will suffer because of that cost of the cocoa is now going up. They can't increase the cost of their basically product to compensate, if you like. So they have to figure out, and they have to basically kind of weather this situation and see where it goes. So what I want to do is now just go over the financials. Now we know exactly why the stock's down so much, and the expectation is not as great as it was. And this could potentially change in the next few months or even a year or two. And I want to buy this company basically moving forward so I can actually, you know, this situation will pass. We've seen that with semiconductors and all of these other companies that we always talk about. As you can see, a year to date is actually flat. For 1 year, it's down almost to 29%. It has a forward PE right now of 19, which is quite low for this company. And I'll show you the 5-year average in a bit. So let's have a look at a bit more detail about the company. So they do have market cap of $38 billion. They do have almost a 3% dividend yield, and that dividend yield is very, very safe right now. It's about 93. The highest you can get is about 99. Now, in terms of the payout ratio, so this is basically how much of their net income they're spending to pay that dividend. So it's about 46%. So that gives them room to increase that in the next few years. If you look at this company now, basically latest increase of February was 15%. So they've increased that dividend 15% despite the expectation of potentially not doing as well as they were doing before. That shows that you know their cash position right now, if you think about it. So the last 10 years they've increased that dividend for basically the last 5 years they've increased it for 10%. And now in terms of the growth side of it, 14 years of increasing that dividend and 94 years without a reduction. So they've paid it for 94 years, and 14 years of that basically they have consecutively increasing every single year for 14 years. Right now you'll get $5.48 for every share of this company that you own. They go on ex-dividend on the 20th of May. That means that if you buy a share before, then you will basically get paid June 17th this year, inshallah. Now, in terms of the valuation side of it, if we use the dividend theory method, you will see here that basically says they're undervalued. Why? Because the 5-year average for the dividend side of things, so the yield used to be for the last 5 years on average was about 2%, and right now is almost 3%. And the forward PE used to be about 24, and right now we're looking about 19.5. So for that reason, the stock actually seems very cheap at the moment. In comparison to consumer staples, is bang on, is exactly the same. And the earnings payout ratio is like right now we've seen it already 46, but next year is going to increase about 57. So that's a little bit worrying, but I wouldn't worry too much about it. If the revenue increases the next couple of years, then potentially this can come down again. Now, in terms of the earnings per share, you can see it has grown from basically since 2014. It's been steadily growing every single year, which is quite nice to see. Free cash flow per share has also been doing exactly the same thing. And shares outstanding has been declining. We like companies that are buying back their own shares, especially when they are cheap. So right now, I would love the company to spend more money buying back their own shares because they are cheap. I hate when companies buy their shares when they're expensive because it actually defeats the purpose of buying their own shares. And total sales start from 2014 it was $7.4 billion in terms of total revenue or sales, whatever you want to call it, and right now we're looking at about $11.2 billion. Next year they're expecting a flat, so about 11.2 again. Return on equity, this has absolutely amazing return on equity of 50%, return on invested capital of 26%, an operating margin of 23%. Free cash flow margin of also 14%, and when it comes to net debt to EBITDA, we're looking at about 1.52. Anything below 4%, it will be basically what we're normally looking for. And just looking at a couple of more things in terms of revenue side of things, you can see it's about 7% currently, but the last 5 years 7.44%. Okay, so we're looking at the average for the revenue side of it. Forward we're looking about 5.4%. Now looking at basically EPS as well, right now it's about 13, and for the average basically is about 12 in the last 5 years. So it kind of is where basically we expected this company to be, and this is probably one of the reasons. So when it comes to free cash flow growth, right now we're in the decline of almost 19%, but in the last 5 years we're looking at about 6.5% more or less. So now looking at the earnings expectations moving forward, so we remember this estimation is not basically, we're not saying this is exactly what is going to happen, so take that for whatever it's worth. So right now this year we're expecting a flat. The next year is about 3.5%, let's call it about 4%. It's 3.7. The next year after is 6.7, 5.5, and then so on. So this is when it comes to EPS. Now when it comes to revenue side of it, basically 2.7, 3.5%, 3.8, 4%. If we just focus on first three, you can see it's about 3%, 4% give or take. And again, this is the type of business that grows that basically slow, and it's one of those companies that I like to call steady eddy companies. You don't expect them to grow 20-30% because that's what the technology companies, pharma companies can do. This is the type of business that, like our foundational stocks, they look after your basically portfolio because they don't have a high beta and so on. You get your dividends and you get your 5% every single year, and if you hold it on to this company for very, very long time, or similar companies, you could potentially be rewarded for that. Now in terms of looking at valuations moving forward, so we'll start with ratings from Wall Street. As you can see here, there's 5 strong buys, 0 buys right now, 19 holds, and 1 strong sell. Now that means we're about 10% upside from here. So $206 per share is where they think the price should be. Right now it's trading to 87. So this does not look good. Wall Street is basically saying, moving away from this company and not touching it. I promise you, when this company was so overvalued, these guys have a different opinion about this stock, and they were basically saying, it's going to go to the moon, and right now it's complete opposite. And this is when I like buying this type of businesses, as long as of course the valuation, the business is still intact. I know the reason why it's down is because of this. Can this change? Of course it can change, because in November of this year it was basically about $4,000 and right now we're looking at about over 11,000. So this can easily change. If the shortage in terms of supply and so on starts improving, this can easily change, and if it changes, then we will see the profits basically going up, the margins improving, and when that happens, then that's when Wall Street will become interested again. And for me, that's not basically investing, that's just a speculation. So I like to invest in this type of business when they are depressed and they are out basically almost. Now as you can see, according to Morningstar, it's 4 stars right now, 10% discounted from where we are now. $208 per share is where they think the price should be. And of course this company has a wide economic moat. Last 10 years in terms of total return, we're looking at basically about 9%. Now if we then go into compare it with the S&P 500, which we like to do sometimes, okay, this company will give you more or less what the S&P 500 will give you, but because of we're basically compliant investors, you can't invest in the S&P 500. So buying this type of kind of business, for me, it makes sense. So if you look at the last 5 years, so for the total return, you're looking at about 65% for the company, 72% for the S&P, and when you look at the last 10 years, 142, including basically 168. So not far off from basically what the S&P has and S&P 500 has done in the last 5 years, 10 years. Okay, I'm finally taking into all of this into consideration: Morningstar valuation, seeking alpha, multiple is valuation model, dividend discount model, which is basically what I've come up with. Simply Wall Street. Take all of those 5 into consideration. What is the average intrinsic value? $210 per share is where they think I basically should be. Current stock price right now is 187. That gives us about 12% upside from where we are. If you say, you know what, I need a margin of safety because I don't know this Coco situation might be in or whatever, 5% will still be give you that. It's still a buy. Even if you did 10%, it will still be a buy, of course. So yeah, so even if you say, okay, I want a 15% just because I want to be safe, then you just wait for another $10 or so drop from here, and then potentially you can get actually good price. Now, before I finish off, Sharia compliance side of things, according to Zoya, we're looking at business side of things, 99%, and in terms of our interest-bearing debt, 13%, and interest-bearing securities about 1%. I hope you're enjoying this type of content, and if you are, please join us in the Patreon account. Okay, have a wonderful day. Assalamu Alaikum.